Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 4th, and today's vibe is markets trying to price the future while the future refuses to sit still.
I'm your guest, and I would like to file a complaint. My portfolio asked for steady compounding, and the market delivered AI panic with a side of gold at $5,000.
We'll keep this tight. AI fear hits software and chips. Gold flirts with $5,000 again. Australia's central bank goes hawkish. And we preview Alphabet's earnings and why CapEx guidance is the real headline.
Subscriptions, safe havens, and rate hikes walk into a bar, and the bartender says, "That'll be 12 times forward earnings, please."
Story 1. Stocks wavered after an AI-driven sell-off in software, with headlines calling it another round of AI fears battering stocks. The core worry is simple. New AI tools could reduce the need for certain software subscriptions or pressure pricing power.
So SaaS is having that moment where it realizes the S stands for subscription, and customers are like, actually, we'd like to unsubscribe using a robot.
The finance behind it. Software companies are valued on recurring revenue and high margins. If investors think AI makes a product easier to replace, they haircut future growth, and the valuation multiple compresses fast.
It's basically like paying for a gym membership because you love the idea of abs. Then AI shows up like a free home trainer, and you're like, wait, why am I paying $99 a month to not go?
Why it matters for normal investors. If you own broad index funds, software is a meaningful slice. If you own tech-heavy portfolios, you're exposed to multiple compression, even if revenue doesn't collapse, because markets price the risk of it.
Actionable move. Do a 2-minute AI substitution audit. Which holdings sell tools that AI can replace, and which sell picks and shovels, compute, data centers, security, compliance, that AI actually increases demand for.
Story 2. Risk-off flows. We saw reports of stocks struggling while gold reclaimed the $5,000 an ounce mark, and another note pointing to geopolitical tension pushing investors towards safe havens.
Gold at $5,000 is the market's way of stress eating. Like, I'm not saying I'm panicking. I'm just buying the entire snack aisle in bar form.
The simple version. When uncertainty rises, investors reduce exposure to riskier assets and rotate into perceived stores of value. Gold can benefit from that, especially when the market wants something not tied to any single company's earnings call.
So gold is like the friend who never texts back but always shows up when there's drama. Not helpful day to day, but suddenly everyone's like, we need you.
Practical takeaway. If you're adding a hedge, size it like a seatbelt, not like a new engine. A modest allocation can reduce portfolio drawdowns, but chasing a crowded move after a big spike can backfire.
Yes, if you buy after it rips, you're not hedging. You're auditioning for a role in Buy High, the musical.
Story 3. The Reserve Bank of Australia reportedly broke a 2-year pause with a hawkish hike, taking the cash rate to 3.85%. The narrative is sticky inflation, and markets read it as a potential tightening cycle, with AUD/USD popping above 0.7000 in that report.
Australia said, we're not done, and the Aussie dollar said, say less. Meanwhile, anyone with a variable mortgage is like, please say more, but softer.
The finance behind it. Higher policy rates tend to support a currency because investors can earn more yield holding that currency, until growth risks show up. It also changes carry trade math globally, which can spill into broader risk appetite.
Carry trade is basically, I borrowed in cheap money, bought higher yield money, and promised I wouldn't get surprised. And then the market said, surprise.
Quick hit. Alphabet's Q4 earnings preview. The key point in the feed is that investors are focused on whether AI and cloud momentum can justify the premium valuation, and especially what 2026 capital expenditure guidance looks like.
CapEx guidance is the corporate version of, how much are you about to spend at the gym? Because the bill comes before the glow up.
Exactly. AI infrastructure is expensive. Chips, power, data centers. If CapEx rises faster than profits, near-term margins can get squeezed, even if the long-term story is intact. For investors, that's the trade. Future dominance versus present cash flow.
And speaking of great story, spicy expectations, AMD was down 9% after reporting earnings because the AI boom doesn't just want growth. It wants growth with perfect lighting and zero blemishes.
That's the lesson. A stock can fall on good results if the market had priced in even better. In high-momentum themes like AI chips, guidance and competitive positioning can matter more than last quarter's numbers.
So today's survival kit: don't confuse AI changed the world with every AI stock as a bond. Trim concentration, keep some dry powder, and stop refreshing the chart like it owes you money.
Recap for 2026 February 4th. AI disruption fears pressured software, gold moved back toward $5,000 on risk-off flows, the RBA turned hawkish at 3.85%, and the big tech focus is CapEx, especially into earnings like Alphabet, while chip names remind us expectations are the real boss.
If you enjoyed this, subscribe and send it to the friend who says, "I'm diversified," and then you look and it's 14 different AI tickers in a trench coat.
Thanks for listening to BD Daily Finance News Podcast. We'll be back tomorrow with the next set of numbers, narratives, and reality checks.